Hello, everybody. My name is Bob Klefsis. I'm president of All Star Financial and want to welcome you to our second quarter webinar on our newsletter that talks about As the Economy Thaws, as the title, Markets Grind Higher. Giving you a little bit of background, Bob's Corner talked a little bit about what's going to happen in the second half of the year with the market. Will the market continue to climb? And the big question is potentially answered by yes, if the economy still shows signs of improvement continued, if corporations can put to work a little bit of that cash in corporate profits. I think the answer could be no, based on the fact that we're going through really right now at the tail end of a 5.5 year bull market run, and there's a correction that's probably a little bit overdue with a slight overvaluation in the market. That's why we have cash in hand. We think cash is better than bonds at this point, with the interest rates bouncing up and down between 2 to 3%, and bonds having kind of every other quarter, a good quarter, a bad quarter. We think cash is going to be a good positive for us. If we look at the market overview, investors really are looking beyond the global headlines and the favorable economic trends right now in what we consider to be the thaw part of the market, where we were kind of frozen there in the first quarter. We see a 2 to 3% projected GDP for the second quarter. We see continued interest rates staying low. We see the Fed tapering, which is all positives, from 85 billion a month to 35 billion a month. And I think they'll keep interest rates low for the extended period of time, probably through 2015. We're seeing Europe and Japan as positives. And their growth out of recessions. Even though we're seeing the Middle East and Ukraine with hotspots, they basically have outperformed the domestic side of the world. So global markets, I think, are going beyond the tensions and basically outperforming the U.S. this last quarter. When we look at the economy on the U.S. side, we're seeing that rebound, as we said, from a negative 2.9 to a positive 2 to 3. Job growth is really the big thing that we like. We see the foundation of somewhere between 200 to 250,000 jobs a month. We've averaged about 272,000 the last 3 months. Some say it's because of the inactivity in the first 3 months of the year because of the cold winter. Unemployment is down to 6.1, 63% labor participation, which is low. Inconsistent housing. So there's positives and negatives kind of going through. Consumer spending spent at a 3.7%. Highest consumer confidence we've seen in a long time. The negative is the consumer income only increased at about 2.4. So people on average are going back into debt. Big ticket purchased items were a big buy. Cars, there were millions of cars bought, more than in the last quarters combined. Inflation, we still have a low CPI at about 2.1, which again is going to bring benefit to everybody in the eventuality. U.S. economy looking forward, we can basically say that these new jobs that we've added are good, but it's slower than the previous expansions that we've seen. Housing is still weaker, business spending is weaker, M&A activity and cash buyouts, that's a positive and a negative. If you actually have a merger, it's a negative from an employment standpoint because you don't need 2 CFOs, so people get unemployed there. I think there's some positives in the economy looking forward, with energy production and revitalization of manufacturing in the U.S. being really, really good positives. On the bond side of the world, everybody is really surviving the Fed tapering. I know there was a lot of question of what was going to happen, but bonds have thrived. We've seen the 10-year Treasury come down about 20 basis points this last quarter. Yield spreads are lower on all bond types. Default rates are lower, which is good. Emerging market bonds were up 4.8%, followed by corporate bonds at about 2.7. Corporate high yields, which outperformed everybody else last year, were at about 2.4, and the aggregate Barclays was at about 2. So looking forward on the bond side of the world, the 10-year Treasury, we believe, is going to continue to bounce somewhere between 2 to 3%. Currently, it's right in the middle right now at 2.5. It came down from 2.7 last quarter. I think the aging demographics helps bonds with the demand there. The decrease in bonds issued, the supply is less. So supply and demand actually helps with the pricing. I think rates are higher at the end of 2014 is the big question. I think they'll stay within a parameter, but they bounce down. They may bounce up this quarter. So diversification is really the key with the uncertainties. Government bonds, we have not as much as we do credit-related bonds and emerging bonds. But again, diversification is really a big key. When we look at the domestic stock market and we say, okay, what's going on there? We've seen really steady gains, but these steady gains have created fewer bargains. When you look at the U.S. indices and kind of the broad market, Russell 3000, 4.9% positive for the quarter. Value and large growth stocks at the same 4.9%. Large caps outperformed. Small caps 5.1 to 2. Leading indicator or leading sectors, for the quarter were the energy and utilities at almost 12% and 8% respectively. Lagging indicators or trailing sectors were basically still positive. We saw financials up about 2.3. Consumer stocks up about 3.1, not obviously as great as energy and utilities. Looking forward on the domestic side, we think the low volatility will help the market, or it could hurt it. The negative side of low volatility is it's there because business spending is lower. Hiring is not as great. We might see a pickup in that in the fourth quarter, which we hope. The positive to lower volatility is that there's cash there to create some energy in the market with mergers and acquisitions, and IPOs and activities there have increased also. The Fed is also going to do everything they can to keep interest rates low, so that's a positive. On the international side of the equation, we're seeing basically international stocks rise above some of the risks that are out there with Syria and Iraq and the Ukraine under attack at kind of as we speak. There's really hasn't been a lot of worries about that, and I think that's because people are starting to realize that the emerging markets are a really good buy. They were up 7%. That was led by India 16.8 and Brazil at 7.6. Japan had a real solid quarter at 7%. Europe is coming out of the recession at 3.2%. EFI, which is Europe, Asia, and Far East, so a combination of Japan and Europe, averaged 4.1. European Central Bank, again, we want to mention that they're keeping interest rates as low as they possibly can, very similar to the U.S., so very positive there, and I think that's why the international markets worked as well. The European Central Bank also added in some bank financing, which is a benefit to businesses, which I think was smart. When we look ahead for the international markets, we still look at them as good value. Emerging is still better value than the U.S. equities. Europe is at the early stage of recovery, as we've talked about. China and Japan have their economic reforms that they're battling right now, but still positive. Oil has been volatile, but less dependent on the Middle East, which is a positive thing too. In summary, we're going to say that things are mixed, and you probably felt like I've just kind of been talking a little bit out of both sides of my mouth here in the last 5 to 10 minutes, but we really have, because the signals with the economy appeal stronger, but really the question is, where's the value even if it's stronger? U.S. stocks, we believe, are better than bonds for the next 12 months. Foreign is better than U.S. stocks, so we're looking more favorably on valuation there. And there's still that 5 to 20% correction that is possible based on we haven't had one for almost 5.5 years. High cash allocations I think will benefit, and again, having that cash in your portfolio, we're going to put them to work a little bit here in the near future, but it's been there for the downside risk that we thought was there. Flexibility helps overcome uncertainty in the retirement. On our 5th page of our newsletter, we talk about a topic. This topic is how important is minimization of risk while you're saving money compared to while you're spending money in retirement. That accumulation phase is really, really important to reduce volatility, minimize that risk as we do as our standard discipline. However, when you look at a distribution phase, probably the most important thing is when you retire, not necessarily volatility of that time period. So what we want to do is we want to look at not retiring before a big downturn in the market. Not that we can predict that, But if you're looking at a financial plan, you want to make sure that you can retire at the bottom of the market, not the top of the market, and have that market come back down. So the solution is basically stay flexible with your date. We don't talk about just one specific date. We talk about a range of dates. Rein in the spending, if the market does go down, and reduce risk in your portfolio before you get to that retirement window, so you don't have to worry about that downside risk and retiring and having a downside for 2 years, and all the accumulation that you worked hard to do kind of goes for naught. We always do it just for fun. From a restaurant recommendation, Nico's Taco Bar in Uptown is fabulous. Matt was kind enough to ask his mom for Matt's family recipe on the fresh corn salad. Fantastic. Quote of the quarter from Albert Einstein: "The world as we created it is a process of our thinking. It cannot be changed without changing our thinking." So again, a great quote. We would like to end by saying thank you for your confidence in All Star Financial. Thank you for the referrals that you've given us, and be sure to give us a call at any time that you have a question or need an answer. Reading a magazine article or newspaper article, let us know. If you have questions, we'll be happy to weigh in on our thought. When in doubt, check it out. Thanks, guys.